Hey, good evening, guys. Mic check and screen share check. Okay, I want to get started with a quick lesson on execution risk and position sizing risk, and knowing what you have in hand and valuing that before you run back out to get the next trade. And I'm going to use an example of Tesla on a 10-minute chart. And so the first thing that I want you to notice is, this is from the daily report. And I'm looking at Tesla. And this is today's closing stats, but the number for the things of interest, the R10, the my risk, and my risk divided by 3, and the range stat really are not going to change that much day to day. It so happened that Tesla was down 3% today, which is this move from here to here. That's a 3% move on a 250% stock. So that's a move from 235 to 225, which is $10. So if that move from here to a close down about here is $10, what can we say about that? What can we say about a $10 move? Well, I can just go over here and say the range stat is $12. And so it moved $10 out of a $12 range stat. So that's about 85% of a range stat move, which we know is a maximum reasonable intraday move. So on that move, yeah, that's a pretty good move, but it's not an abnormally large move. It's probably a little bit larger than average, but not much. So I would consider this just to be a normal moving day inside of Tesla. So let's remember that. Now, if I use 1/10 of the range stat, or the R10, then my statistically derived minimum manageable risk box, what I'm trying to come up with is my minimum manageable risk box. Is this a reasonable trade frame? So I'm going to start with these risk sizes that are derived from price action stats. So I'm trading on 10 minutes. So I'm going to have about 50 bars. Excuse me. So that R10 is this size. That's $1.25. If I go to my risk, that turns out to be yesterday's range risk plus 10 cents. So that's about the size of a daily range. So that's $8. So that's $8. This is $1.25. And then if I just take my risk and divide that by 3, it's about $2.66, which is approximately here. That's the size of a reasonable intraday swing-oriented trade. It's not bad. So I could be using about $2.50 or $2.66 would be the size of that yellow box. So those different sizes are derived from the previous price action stats. Yesterday's range plus the average of the ranges of the last 30 days. So now I'm interested in this as a trade. Here was the close from yesterday. And I'm going to wait about, let me wait 90 minutes or so, or 60 minutes in this case. And I noticed that the PSAR flips almost immediately, and that thing's moving down. And you get some of this vigorous price action, but I don't have any information yet about today's move. And so I'm not going to get distracted by the size of the bars. I'm going to look at the peak of the RL10, the belly of the RL10, and then I'm going to draw this line across, and I'm going to say, you know what, that RL10 equals price. So now what I notice is in this bar or in this bar, the RL10 has come out of this channel, right? And has given me essentially a collapsing dragon. So you have a reasonable range of entry in this area, whether you got into it in this bar as it was collapsing, or you waited for it to come up and then roll over again. You should be getting in somewhere in this range. Wherever you specifically enter, and I'm just going to use this bar here as the example, the execution risk is derived from the actual frame of the trade that you see unfolding in front of you. And the limit on that is going to be the PSAR dot. So I'm drawing that green box as the execution risk. Now, how big is that compared to those other statistically driven boxes? Let's just go look. So it's actually essentially the R10, which is an aggressive risk box, but not overly so. So then what I want to do now is I want to work through the trade just using the R capture of the execution risk in order to see what kind of ordinary routine move could I capture from this entry as this trade unfolds. And then we're going to come back and talk about position sizing risk and R captures and ways to think about it. Now, this technique that I'm describing is also a way that you can learn to practice framing and exercising the implementation of trades to build your own preferred style of trading and testing your rules. So I'm going through the mechanical trade frame right now. So I should be getting an entry on the short side right in here in a collapsing dragon. I mean, I notice that the excess upside move has failed, and it was only ever in the spring, and now it's starting to get into the winter. So in addition to the signals that you have a specific collapsing dragon here, you also can notice that you have a spring, and this thing is now becoming winter. So the direction is clearly down, and you have the PSAR showing you the way downward. There was already a gap down, a harsh sell-off, and a recovery, so we know that the buyers don't even start coming in to this level. So that's going to be a test. And so if I have this as my execution risk, there's a 2R if it just goes back to the low of the day. So as I draw this line across, I should be very interested in a 2R battle drill right here, because I've got 2R in hand and it just broke to a new low of the day, and I'm only 0.2 of an R stat so far, because that's about an R10 and I'm at 2R. So I still got 8 more of those boxes left to the downside before this becomes an irrationally large move. Check or hold. So now I've got some kind of orderly move. It comes down here. Now notice almost always on the first, after the first leg, and you get this move, it is a very good sign that even the price can't get through the dragon. It rejects at the spine of the dragon. That's the collapse of buying pressure right there. All of these little guys, these traders that came in with leverage on the shorter time frames or buying single stock futures that are trying to induce some buying action to go this way to establish that as the low of the day, they failed right away. And when those guys fail, they bail. You could write that down. When they fail, they bail, because it either works right away or it doesn't. And because we're trading on 10-minute time frame here, that's 30 full minutes for these guys to make this a massive move of the day. But it wasn't that kind of day at all. Everything about today showed failure. So I'm not surprised to see this fail. But even after that first little tactical counter trend, which then fails quickly, notice that the RL10 is not very impressed. All it did was go from big red to sideways and then started to resume down. You wouldn't be wrong to put a second position on right here. You would not have been wrong to go to 1, 2R and had your second position in here. Now, I will tell you that if you put your second position on right here, you must be prepared to execute an exit right here, because you now have a dragon, because you cannot let this thing, which has been positive in your favor for 1, 2, 3, 4, for 40 minutes, then start to reverse for 2 bars and get up. You've got to keep that as a no-lose plus dinner for 2 exit inside of that second entry. But if you just use one entry, then you can just kind of wait and see what's happening. And if you just decided that you were going to profit take at and lock in 2R, you could have a money management stop here, and although you were getting close, you still had a little wiggle room according to your rules. And if you were aggressive, you could say, oh, right here, as it leaves the dragon, I can even get a second position there. Right here. On price action. But we'll just keep it at 1. So now we had that first recovery. It fails. Now we have a second recovery happening pretty close. Now, when you see that happen right now, notice that this time price got all the way to the edge of the dragon, whereas this time it only got to the spine of the dragon. And now notice that this next surge happened after only 20 minutes. So there was a spike down, and then that reversed. This thing is running out of gas. It's supposed to fail further. When this little effort does not materialize, our expectation, our demand is that this move should become that move right away. The fact that it didn't, I say, where's my second leg failure? So that could cause me to exit here at the edge of the dragon. And now I notice that the RL10 is starting to improve. It becomes spring right here. I'm not offended by getting out here, especially as it's now starting to penetrate the top skin of the dragon. Well, this continues on, and then the RL10 comes into the dragon, crosses the spine of the dragon, leaves the dragon. So you are not crazy to exit anywhere inside there. I like either one of these. I like the spine of the dragon. The one I took was this one, for purposes of this discussion. So let's see what that one trade did for us. Now, hey Ken, but why don't we hurry up again? Just hold your horses. And I want to think about what to do when you have a bird in the hand. I don't want to trade more. I want to trade less. When there's enough selling interest in the most important stock in the world to do that, and the rest of the market is suffering, it's not my expectation that this thing is just going to run away. So I'm not going to be in a hurry on that. So if we get this exit here, I can now I want to just hit the tote board here and say 1, 2, 3.3. This is a 3.3 execution risk. Well, how much of a position size risk is that, Ken? Well, if I want to compare it against, and if I want to have standard position sizes, I might be persuaded to be using some of these numbers to decide how much of my $400 risk per trade to put into the number of shares. If I use $1.25, then I'm going to have 325 shares. So let's call it 300. And it got short at about 232, and it risked that much. So for every dollar risked, I captured 3.3 of the execution risk. So it got short at about 232. It gets out at about 227.50, let's just call that. So the capture of dollars per share, just from an execution basis, is $4.50. So if I have $300, I'm sorry, if I have 300 shares, then I make $13.50 dollars, American dollars. If I decide to use the my risk, that's 220, that's 266. That's about, divided into 400 is about, let me just estimate, about 150 shares. And then we're going to make we'll make about half of that. So that would be about an $800 trade. Now let me just suggest something here. If you're in the trade at 10:30 and you're out of the trade at 1 p.m., 90 minutes of work, and let's just take the smaller number, at $800, if we just use the wider stop, you're making about $550 an hour to frame a standard trade with a very wide position size risk with a carefully defined execution risk, a completely normal move with a couple different ways that you could get out, a couple different ways to get in, which rewards you right away. Son, what if you're done for the day? What I want you to think about is this idea. If I simply decided to assign a value of 0.3 position sizing risk to the execution risk, then that means I'm using about $3 of risk, because I could come over here and measure that out. If one execution risk is arbitrarily set to 0.3 position sizing risk, and my trade is worth 3.3 execution risk, then what was the capture on this one? It's a 1.1R move. All right? So if that was the trade that I did today, and now after a couple hours of work, I'm at 1.1R. Now, let's just say that with the sum total of my trading, if I can net 0.5R a day for 100 days, I want you to compute what it means to compound 0.5R a day for 100 days. Well, why is that, Ken? Well, here's why. Because in an independent of the trade architecture and the framing, which does this setup and figures how far, determines how much I can risk and what's the execution risk and what is the maximum forward reason. Look, on this one, I only went 1, 2, 3, 4, 5. That is, excuse me, half of a range stat. This is not even close to an outrageously successful trade. That is half of the maximum reasonable interest. That is less than an average move. And it produced 1.1R. So let's round that down to say, if I could net from operations 0.5R a day, I want you to calculate what is 0.05 raised to the 100th power. So 1.05. So get into Excel, build you a little column or use the power function and figure out what is 1.05% for 100 days. Well, here's how you can figure that out, by the way. If you take your value, your 5% rate of return, and you divide that into the rule of 72, that'll tell you how fast can you double your money. At the end of 100 days, you're going to have more than doubled your money. And now, instead of, this is addressing the variable of how much to put into each trade in terms of dollars. So now, if I decide that as these trades are successful and I am accumulating positive dollars, I can take each successful trade and decide what percentage am I going to put into my long-term grain storage bin? What am I going to put in the barn and take it out of the system? And what percentage am I going to roll into operations and grow the size of the trading capital? I'm going to take the gains that I make and put in the barn, and I'm going to make bread on that. And the seeds that I harvest that I don't turn into bread, I'm growing my seed corn. So one of the ways that you can achieve real results in your account is to always keep the trade framing based on the situation, advised by statistics, know what the size of the normal moves are conservatively. And when you get a conservative move here and you say, you know what, reasonably I'm holding 1.1R on that trade, do I need to monkey around with this at all? I do not. I'm coming into the lunchtime in here already. And I only have, when it comes out of the lunch, I only have this much time for a secondary trade if I want. But your sweet spot most of the time is going to be in here. As the market responds to news and other market conditions, and it makes the move of the day, all of this stuff is hard. And you got to learn to value what it is that you have in your hand from a basis of simplicity. 3.3 execution risk off a standard trade frame on a 10-minute chart, my friends. So, do some math and come up with your answer to the question, what is compounded 0.5 execution risk per day? Once you have a standard black box of your trading machine, this is where the trade frames are and your trading architecture and all that. And you're bringing a decision of how much money to put in there for you to turn the crank to come out with the R capture on the basis of the trade frame, so you can see what the value of the architecture is independent of the dollars at risk, because that's a different variable. And then you can use the stats of consistency and trader quality number and all that. The statistics of the R capture will then help you decide how much you're willing to risk in actual dollars. So if my total portfolio is this, and I'm really trying to decide what is the percentage of that total portfolio that is my upper limit on dollars at risk. That is sort of how you derive from math the dollars at risk. This is a very rational calculation. And this is where financial engineering allows you to maximize the maximum reasonable dollars at risk as a percentage of your capital. That is your rational brain doing that analysis. Your gut brain doesn't want to hear any of that. Your gut brain says, let me start with $1 or one share of risk, and as I prove this thing going forward, I can increase this to 5, to 10, to 20, to 40, to 50, to 100. By taking some of the profits along the way and rolling that back into the dollars at risk. So I take that successful trade, the actual money of the trade, maybe I just split it, I don't know. and put that and take that out of the system. Because what you remember is you're starting off with a new system. And it's speculative because you've never traded it live before. And you've decided to put some amount of money as startup capital into this franchise. And then you're going to track the performance. And so if this line represents the amount of initial risk capital, actually, let me draw that in a better way. If I've got my black box system and I've decided to commit this much money to it, I can come over here and say, look, I've already decided that I'm going to risk that much money. And at the start of that thing, you should say, you know what? I expect this thing to fail completely until proven otherwise. I'm not going to be surprised if it completely fails. So if this represents how much money I've decided to commit to it, then what we want to see, if we have a successful trade, and I decide to split that, I can say, let's just call it a half. Let me put 1/2 into the barn for my money. And when I say that, it means it's not staying in the system. The system is exporting that to the barn. So if I get a winning trade, and it's that much, I can say, let me take that much and put it in the barn for other purposes. That's like, think of that as a dividend to yourself. That's what a mature company does, is they pay the shareholders who took the risk. So get in the habit of paying yourself a dividend for the risk that you take. And then maybe take the other half or whatever and say, the capital that I have that I'm using in my little bag of seed corn is going to grow just a little bit because I had a successful trade. And then what we're going to see is that over time, you start off that far in the hole because you decided emotionally that you had already lost all that money. But instead, this thing starts working. There will come a day when your system and its growing dividends will have completely paid off the venture capital that you put in here. And now this system is net positive expectancy compared to the amount of money that you put into that. And now this is all pure profit that system has earned. At somewhere in this curve, but not later than here, you should think about the fact that you have the statistics of live trading that shows that this whole setup and whatnot is forward tradable with evidence that is inductive. It is based on actual forward trading. And so then you can have at some point taken money out of that system in the form of a dividend, and then you can have the size. It has not, this system rule set has now earned all of the money that it's using to trade forward. So you could actually bring that to full rate production and increase the size. Well, you could make a decision. I want to pay myself more of a dividend, or I'm now content to leave this thing running at its current size and let it just pay everything. It has its own working capital, and now I can pay 100% of that to the barn. That means I'm never going to scale up, but it means that I'm going to continue to draw free money for the rest of my life. That is a annuity or whatever, as long as your monitoring of the system shows that it is continuing to perform in the expected manner. Well, how do I do that, Ken? Well, here's how. The 30 trade rolling expectancy is going to produce some kind of equity curve and average R capture, and you simply put plus or minus one Bollinger Band around there. And at some point, if this performance comes down into here, you can now say, you know what? I don't know what has changed in the world, but I now have evidence that it has violated the lower control limit of normal system performance based on the evidence of how that machine worked. Now, I don't know why it's doing that, but we can analyze that to say, is this coming from a change in the market? Was this just a seasonal issue? Have I changed my operational performance? Am I taking extra risk? Have I varied the rules of the system? And is that what is attributing? So we can do some causative analysis to determine what went wrong with that. That's how you do industrial production on a machine that's making bricks. So I just bought a brick making machine. A brick making machine. That's my little rule set. And what I do is I bring mud and straw into that thing, and I turn the crank, and it produces standard bricks of R captures according to some frequency. And I'm studying those for performance characteristics so that I can determine what the performance of my system is in terms of R capture, independent of the dollars at risk. I'm studying the performance of the system. I'm tuning it and calibrating it. Maybe I'm making some decisions on that basis to try to improve the rules. And maybe that's going to, maybe I make a rule change here, and instead of failing, it goes here, and I can now say, oh, you know what? That is a statistically significant improvement, and now I can have an expectation of this thing performing this way up that channel as we go. That is the basis of our trade performance review process to determine how the industrial machine is doing. That's where 100%, that's where 90% of your managerial effort should be going, is looking at the statistics of the rule set and the architecture when traded exactly the same way each time with your standard rule set. Not spending, you got a little worker down there who's trading his butt off. Instead of questioning that guy and putting a lot of discretion on him, study the rules. Make it clear to the guy doing that your job is to run the machine exactly as I taught you to do it, or as you've decided to do it, error-free. You're not, hey, this guy is not responsible for the results of the rules. He is responsible for faithfully executing the rules. You can't put managerial responsibility on the guy who is also doing the trades at where the rubber meets the road. You got to free his mind of that. So as you think about the trader, his job is to execute, and then as soon as he enters, he's under maximum stress, and he's going to feel a 1-hour loss already. So we're going to save him by bringing in my fireman, the guy whose job it is to get that to no lose plus dinner for 2. That is your goal. Use the fireman to save the sanity of the trader. And then hand the management of that trade off to your assistant manager, who's going to use your rules for managing the trade routinely according to your exit strategy until it becomes an above average trade. When it's an above average trade, then and only then you bring your sniper in to begin to preserve more of the great big wins. So look at all the different guys that we have involved in here. We have an architect who is building this trade frame. We have the analyst who has provided all of the stats and all that stuff. We have the risk allocator, the banker, who is making sure that we are never exceeding the authorized dollars per trade, because that's the guy we're going to murder if he dares to give those guys more money than is authorized. And then we have the trader who's going to execute, and he's ready. And then we have the scout who's going to look for the specific conditions to say, yep, we got a target. And then the trader and his spotter, call him the scout, they execute that trade, and then the fireman comes in to save them, and then we hand that off to the assistant manager, and then we have the sniper. So there's about 9 guys involved in there. Guess who's managing those guys? You. That's the guy. That's the leader. That's your chief of staff. If you ever worked in the factory, that's your foreman. He's the shop officer, the guy who's running the industrial plant. And that guy is making sure that all the machines are running. And that's the guy that is responsible for ensuring that all our operators are trained and performing this and just trading in standard ways so that we can use statistics to come up with information about how and where to start changing, adjusting, modifying our rules. And so this whole process starts with, we did enough back testing and design and all that jazz to decide to start risking real money and then trading at the smallest level of risk until we have forward trading evidence that this thing is actually good to go. And then we use the positive results of that to pay down the risk we took in building it by increasing the money in the barn, and to start increasing the size of the trading capital for that system. And then what we're going to do is we're going to have a number of systems, each one of which is going to have performance characteristics. And then what we're going to do is we're going to have our senior risk advisor deciding what percentage of total capital to put inside each line of operation. And then our designer and our strategist is going to ensure that the number of systems we have, we're trying to get diversification in terms of system, so that these things are not really all the same system. We want to see that they have their own characteristics. So if I saw something like that, I'm going to say, oh, well, maybe this has gone down enough that I can start rotating money to here. So maybe I have, in that sense, maybe I had 5 systems that are independent, least correlated, and I'm going to decide, you know what, I'm going to put 10% of my capital on each one of them all the time once they are true production systems that have earned through evidence to be trustworthy. And then maybe that leaves me plus 50% of my trading capital to decide how much I want to increase, maybe up to a maximum of 20%. Maybe that's what I do. Or maybe up to a maximum of 30%. So I could decide for each system, like system 1, he could always have 10, and he might go to 15, 20, 25, and 30, but never more than that. Because if all the systems have 10, I got to figure out for systems 2, 3, 4, and 5, how much more to put on each one. And how am I going to do that? On the basis of the performance of the rolling 30 trade performance. That shows me which system is more in tune with current market conditions, which are mysterious, but which can be observed as a result of the results that we get by engaging with that mysterious process. And in that way, I can bring industrial strength assessment and analysis to the performance of my trading systems. I am not trying to make I'm not trying to make money here and then give it all back in here because I'm in an urge. Because I know what I got. When I can do that on one position, and I can get 3.3 execution risk, I guarantee you, you don't need anything more than that for the rest of your life. I don't know what the specific frame is, but if you can do that, you don't need to do anything else out here at all. Even though you might notice that there are things to do. Like you might have tried this one and cut it, and tried this one and cut it. Didn't cost me anything. I bought a lottery ticket and got my money back. So I don't care. Nothing venture, there's no risk. But that's the next level up when you can start. You have to be able to get in the zero state after this one and make sure that you've taken care of business. So, do an assessment of what happens when you compound 0.5R a day net of all trades for 100 days. Come up with that number. So for the next 100 days. So as you're starting to trade forward, you should be looking at what is my daily net capture of R from all the different ideas that I'm testing and checking. And what is my rolling average R, as well as total R capture for 100 days. Sniper trade of the day. Yeah, Eugene, that's right. I'm pretty sure that's right. Because if the number was 1, I divide that into 76, and that means if I have a 1% compounded return, then I double my money every 72 days. So if I'm only compounding 0.5% or half an R, yeah. And then what you can say is, what if I'm using 0.5% of portfolio capital and then compounding? So yeah, so if you get 88% in 100 days on the simplest form of our trading, you need to just wrap your arms around that and sit quietly for a while and realize the implication of those numbers. I'm 100% serious when I say you need to consider that. How can I produce bricks like a business is what I'm trying to teach. Now, here's sniper trade of the day. So this is Dish Network, one of the 30 symbols that I'm tracking in the hybrid swing portfolio that you've seen me for 8 months every day doing at least 1 hour. It's safe to say 1 hour a day, conservatively. So now run 1% compounded daily. Oh, yeah. So this was the last exit of the trade before I had heart surgery. So this is my recovery time in here. And yesterday I was stalking this guy and I said, you know, if it breaks below this line, I'm going to take that trade on the 30-minute chart just because. Just because. What would we call that entry? Team? Collapsing dragon. Every day, all day. Is that my all-time favorite pattern? Yes, it is. Because when it works big and fast. Now, I just drew that black line. Why did I draw that black line there? What is the significance of that line? Yeah, it's the belly of the RL10. And if this fails at any point going forward, then that means all of this crap was fake or false or over, and it's now beginning that move. How big could that move be? Well, I can go back and say, where was the next level of support? So, yesterday, this is when I came home from the hospital. I monkeyed around a little bit here just to get warmed up, but not a lot. So this became a standard entry on the collapsing dragon in the usual way, and it closed here. And we were holding +1 on a swing basis. And then today it gapped down. And on that basis, just using the 30-minute chart, I can add a second position because I'm also at the 2-hour battle drill just on the 30-minute chart. And like a collapsing dragon should do, it failed to here right away. I'm now holding 4R on the first position, and I'm holding 2R on the second position. In 2 days, I'm holding 6R and no overnight risk yet, so I could just decide to get out here. And I could then net, on average, 3R a day for 2 days in a row. And we just looked at what was the importance of being able to compound 0.5R every day for 100 days. You will double your money in a little over 100 days. And here we are at 6 times the performance level of what it takes to double your money in, call it 100 days, 120 days. So double your money once a year. That is 100% per year. And this is 6 times that level of performance. I want you thinking about that and not trying to overthink these little strategies. This is essentially another collapsing dragon from here and from here. And it closed right here. So you could very logically have gotten out here. Hey, maybe you just take the second position off and then you bring this stop down to here to the PSAR flip and just carry one position overnight. Because do you know what you already know? You already know how to re-enter. Now this is if I'm just trading on the 30-minute chart. What if I decide to pick this one out of my 30 standard symbols that I'm monitoring every day on the 30 minutes? Say, you know what? This thing is actually paying off. And now I can just drop down to my 3-minute chart. Now this was where that first hybrid swing risk was. And this was the size of that risk box that was appropriate for holding a position overnight. This is about, it's about 15 cents. It's only a $7 stock, for crying out loud. That's a 2%. That's a 2% buffer. So that's not crazy. And now this turned out to be where I added second position on the hybrid swing. You know how I do that? I'm on the 3-minute chart and I make this entry right here. This is the standard normal intraday turbo position. And here's the logical place to get out of that before I go overnight. That, on the 3-minute chart, adds 4.2 with no overnight risk. And I keep the second position on, which was coming from the 2R battle drill, with a wider stop. And now this one you could decide, do I want to just get out of all of that? The second position from the hybrid, which was 2R, and the 4.2R. Hey, guess what I just did? If I do that, I am able to put 6.2R into the bank. The money that I earned from the 6.2R, I can put in the bank. And I can still maintain a 4R in hand open position here. And I might just arbitrarily decide, you know what, let me put my stop tentatively there and declare that that much money is mine. And just risk 1R overnight. Maybe I do that. I don't know. But that's where your execution risk is for tomorrow. A smart guy told me once, hey, don't look into the sun. And if you're tending a fire, make a small fire and maybe watch it a little bit and then scan what else is going on. But don't become so focused on each little individual trade that you're losing your mind and you're gripping the sword too tightly. You have to keep a light hand, a confident hand, a flexible hand, a hand that's ready to surge when needed and to feel the movement of the sword and to hold it just correctly. So if your little trader is in here and he's watching the fire of that trade, protect him against all other issues. He's just supposed to be working on that. And then have your fireman ready to stand by to help him jump in and get that to no lose plus dinner for 2 so that we can lock in that gain And then the fireman and the entering guy can go off and recover and thank them for their service. And then it's the job of your assistant manager to just manage that trade according to the rules. And now it's just a science project. And the data from that is going to go to the quant guys who are going to study it, the numbers and whatnot, and come up with the R and all that other crap. But let that guy and the fireman just go off and have some lifesavers and enjoy that. And then they'll walk with the monkey and say, hey, thanks for bringing that thing to our attention. So the monkey, the fireman, and the trader all kind of go off together to the rest area where they can get ready. And then the fireman comes back to help the next trader. So you got a team of firemen. Hey, look at this one. This one is an opportunity trade. Here's where it opened. And this is Alcoa. Why am I watching Alcoa? Those of you that know me, why am I watching Alcoa? Because I always watch Alcoa. It's one of my standard normals. No matter what. No matter what, I study Alcoa. All of those symbols that are on the hybrid swing, those are always watching them. So I just notice what's going on. It does this little thing. This is when lunch occurs. So it did practically nothing. And then I just noticed, well, this seems to be the size of the channel. It never really got higher than this. The peak of the RL10s. Uh-oh. Are we noticing something here? If you were aggressive, you might say that is a PSAR flip and summer is failing and becoming fall, so we would call that, what kind of an entry pattern would we call that? We could call that a kata 2 and a pocket entry, or a supported fall crossing, because we got lower highs, PSAR flip, and the condition went from summer to fall. So this is the pocket right here until such time as this, the working low of the day, fails. What would we call any entry that is lower than that red line? What would we call that entry? Collapsing dragon. So we might have aggressively entered here. We might have anticipated a move there. So if that was entry 1, the aggressive one, and if this is entry 2, front running the collapsing dragon, if my entry is here, where is my execution risk? Right here. How much is that in terms of R? That's about 25 cents. Not crazy in Alcoa. If I take this one, where is my execution stop? Right here. Or here. Not any closer than here, though. Any one of those, 1, 2, or 3, keeps you in this same trade. Any one of those 3 gives you this one. So what's your hurry? I like this one. So now we get this, and now look what we got. We got lower highs. Now what are we going to call this entry? Collapsing Dragon. You know how long I studied that to set up that entry? Well, I started stalking it at 0930 Central Time, and I pulled the trigger at 2 p.m. So that's about 5.5 hours of tending the fire. Let it cook. Enter dispassionately. There's my standard execution risk. That's 20 cents in Alcoa. If I'm risking $400 on a 20 cent per share risk, how many shares of Alcoa could I buy up to? 2,000. Correct. Maybe you just want to set that, just take 1/5 of that, set that equal to 0.2 position sizing risk, which now means instead of 200, I'm only going to risk 500 shares. And now if I can get short at 30 and cover at 29.20 on one position, adding a position at the 2R and 4R battle drills, and then all out here. What if I just took the first position, though? Instead of 7.5, I can get 1, 2, 3, 4.5. I can get 4.5 execution R, which means that for every every share we made 80 cents times $400, or I'm sorry, 80 cents times, let me say it again. If I set that equal to 0.2, 20 cents, I now am going to use a full $1 of risk, which means I can have 400 shares. And on 400 shares, I made 80 cents, so I can bring home 320 bucks in terms of position sizing risk. If I just become confident over time and say, you know what, I'm going to treat that as I'm going to let XR equal PR, then that is on the first position 4.5R, which is 1,800 bucks. If I implement the 2R and 4R battle drill, I come home with 7.5R times 400 is $3,000 on this trade today from 2 p.m. to 3:30. Stop trying to fight things inside this little grinding river. So you got the trader who's watching the fire inside his little circle. You need the trail boss or the guide or your chief of staff, whoever that person is for you, to say, look, I got a bunch of little traders that are watching the fire. In fact, what I really have is I got maybe 5 or 6, or let me draw it better. Maybe I have 5 little fires that I'm stalking. And I just have my scout out here saying, hey, scout, watch those 5. And you tell me, when is it time to bring the trader and the fireman into position? And when it's ready, I bring the trader in, I protect him, and I say, watch that fire, and fireman, you get that risk out so that we can lock in no lose plus dinner for 2, and then you guys go off and rest. Did your job. Manager, you handle that. Sniper, I'm going to bring you in when this is above a certain average +1 win. I'll just tell you right now, when you got a 2-hour win in hand, bring in your sniper. And be really, really good on that one. And now what you can do is you can be very relaxed with your scout who's just scouting, and the trader who just has to get it to here, and the fireman who just has to get our feet out of the fire and don't get burned, and managers just handling it according to standard rules, and sniper when I need it. That means that you have to cultivate the experienced chief of staff, or the trail boss, or the foreman, or the master craftsman, the senior manager, or whatever. Whatever model of thinking works for you is a way that you can do that. Now, just for Hamad, I want you to go back through that Tesla trade that I just marked up, and you had before, you're doing Tesla on that 30-minute. Here's the move that gave 3.3 on a single position in a routine way down to here. When you zoom in on the 10-minute, here's that move. You got the entry exactly where I got the entry. I was very happy to take this. You didn't see me even think about trading that. Why? Because I know what the value of this is. Don't let 0.3 escape. Look at this. All of this is hurting your feelings. 0.3, calmly, professionally, minus 1.4 in an agitated state to try to get more. Remember, all you're trying to get is 0.5 R a day, and there's 0.3 of it. So you should not be in a hurry to trade that. You should be avoiding the hurry. Go take a break and wait till you are genuinely in the zero state on that one. Let your scouts monitor high payoff frames, like the collapsing dragons, okay? Here's Steve. Let's see, he's got, he makes this trade from here to here against that much risk. He makes bank on that. I don't see what your final number, but it looks to be about 1.2 R. Now, here's what I want to say. If a favorable capture of this can get you to 1R. RLXD, dragon rolls over, PSAR flips. Where are we? Where are we? Where are we? Bottoms out, RLXD, dragon rolls up, PSAR flip. Either go to the belly of the dragon or all the way down here. Get out here. Re-enter here. Span of control. Jose? There's the channel. That's the tactical channel. It's not even interesting until it gets above here. So this entry, look how nice that is. Absolutely reasonable. 1, 2, and if it works, he'll have 2R at the test where it really becomes interesting. Now maybe stuck around too long for -1. But stop and reverse, PSAR flip, there's his 1, 2, and a little change. So his net execution R capture is about 1.4 for the day, because he's using the smaller the fractional execution R. He's in great shape. What a beautiful trade. Just like downtown. Look at the PSAR. Look at how nicely this is supported by summer. Yeah. Fall. All the way down to the test. This is where, if it's going to collapse, you expect it to collapse into winter at the 0 line. Or it's making some noise like it wants to go, so he takes the shot at the PSAR. It rolls over. It says, I've seen enough. And now it just entered the winter. Smash. Where does it stabilize? At the same level it stabilized before. So this was actually a conservative 2R capture. You could have said, yeah, that's actually a 3R potential. And that's basically what that gave in terms of the trade frame. Brian anticipates me by saying, well, oops, let me go blue on that, sorry. Perfect, reasonable, PSAR flip, 2R re-entry, or 2R, yeah. So, frame the trade. Well, here's what I want to say. How can you forget that? I want to say that in a different way. This is a way of your inner voice beating you up. What I want to say is, constructively, how can I not forget? Even that feels a little harsh. How can I remember? Hey, this requires an act of cognition. Here's what the Japanese manufacturers would say. Poke-yoke. Design your work process so you can only make good parts. How can I design my alert and design process so that I must frame in both directions? And it's easier just to frame it in both directions than it is to not. Make it easier to do the right thing. Make it automatic so you don't have to remember. Okay, let's come back to this one. Sorry, I missed that one. Leg 1, leg 2, bottoms out, PSR flips, 1.32. Sideways quiet channel. If you could think about that as a Kata 2. I know he didn't trade that time of day, but there's moves. You don't got to catch them all. Notices leg 1, leg 2, PSR flip. Uses double the technical risk. Possible second position. You certainly would have gotten out by there. He gets paid. Re-entry. Oh. $1.66 for the day. All right, Ahmad, most of my earlier commentary covers all of these, so I'm not going to repeat those. But every one of these, right? You're catching the right move, and then you are aggressively pursuing it. I want you to just get back and relax a little bit more. There's Alcoa. How beautiful is that? That's the other one. That was my, if I remember. Oh, wait a minute. I think I actually took that one today, too. That was the opportunity trade in Alcoa. You took it exactly where I took it. This is pure execution risk with the 2R battle drill added. So there's a ton of really important material covered tonight. I want to reach out with my heart to you, Gene, and give thanks to you for the very important phrase of power that you gave me in some of my darkest moments during recovery, and that is it is good to tend the fire. And that really came to me at exactly the right moment, so I wanted to give you thanks and aho for that sharing. Okay, so that's everything I want to cover for tonight. You have the reports in hand. Let's be ready for these guys tomorrow.